Question number 7. Angelo earned wages of 63,500, received 1,850 from interest from saving account, received 15,000 in winning on television game. So, okay, this number here, these three numbers here is uh, the Angelo income on that particular year. Okay, but this number 7,800 is not income. This number is called adjustment because this is the amount that is put on tax deferred saving plan, and that's called adjustment. Tax deferred saving plan is adjustment, and he's entitled to standard deduction of 12,500. That's the standard deduction. And interest on his home mortgage was 6,500. He paid 2,100 in property taxes, 1,800 in the state taxes, and contributed to 3,000 to the charity. This numbers here is itemized deduction. Let me highlight that with a different color here. This is all number here, itemized deduction. The standard is 12,500. Okay, now let's find the Angelo gross income. All the income that he had is on that particular year is Angelo gross income, which is 63,500. Let's write gross income is 63,500 from the wages plus 1,850 from interest plus 15,000 for winning television games, right? Therefore, this total equals to 80,350 is gross income. Okay, part A is finished. Part B, Angelo adjusted gross income. Adjusted gross income we call AGI, short form. Adjusted gross income equals to gross income minus adjustment, right? Adjustment. And here the gross income is 80,350 minus adjustment is 7,800, which is contributed to tax deferred saving plan, 7,800. If you subtract, you get 72,550 is adjusted gross income. Make sense? Now, to find the taxable income, we got to find the deduction. We know the standard deduction is, I should say SD, standard deduction is 12,550. That is given here. And the other deduction here called itemized deduction. Itemized deduction is all other deduction. You can see here interest on home mortgage 6,500 plus property taxes 2,100 plus state taxes 1,855 plus charitable contribution or contributed to charity 3,000. Okay, this total add up to 13,455. Okay, that's the itemized deduction, and that's the standard deduction. But to compute taxable income, we only use one deduction, whichever higher. Since itemized deduction is higher, we use itemized deduction rather than a standard deduction. Not both. We use only higher deduction. Here, itemized deduction is higher. So, for part C, To find the taxable income, we subtract adjusted gross income minus deduction. Okay, that's the formula. Okay, what's the adjusted gross income? 72,550 minus, what's the deduction? We use this larger one, 13,445, 455. Okay, if you subtract this, you get $59,095. Okay, if you subtract 72,550 and 13,455, you get $59,095. That's the taxable income. All right, question number 8. Okay, question number 8. And this table, this is the table for 2021 tax rate here. Okay, that's what we're going to use in this class. We're going to use this table when you calculate income taxes for the next 2 questions. Okay, all right. Question number 8. There's 2 part of the question here. Use 2021 marginal tax rate. That's the 2021 marginal tax rate to calculate federal income tax in the following situation. The question asks you calculate federal income tax. Okay. Part A. To find the federal income tax, you do all of the 3 things we did before. We got to find gross income, we got to find adjusted gross income, and we got to find taxable income, all. Therefore, let's find all 3 first. Okay, first part, what's the gross income? Gross income is given here. That's the gross income. You already have the gross income. And what's the adjusted gross income? Adjusted gross income, we call AGI, equals gross income minus adjustment. Gross income here is 45,000 minus adjustment here is 4,500. Remember that the pay to the tax deferred IRA. As long as some money contributes to tax deferred IRA, that is called adjustment. Therefore, you subtract 4,500, and you get adjusted gross income, which is going to be 40,000. Sorry, 500. That's adjusted gross income. Okay, 40,500 is adjusted gross income. Now let's find the taxable income. To find the taxable income, you got to find the deduction. Let's find the standard deduction. Standard deduction. Standard deduction comes from the table. This marginal tax rate table. Here, the filing status single, no dependent. Therefore, if you look at the single, no dependent, that's what you're looking for. This column, single column. And for the single, the deduction is 12,550. Therefore, standard deduction is going to be 12,550. But we look for other deduction because itemized deduction. Itemized deduction. The itemized deduction include all this, the given deduction: mortgage interest, property taxes, charitable contribution. That's what given, called itemized deduction. How much total? Let's add it. 3,000 plus 1,500 plus 1,350. If you add all this itemized deduction, you get $5,850. Okay, this is the standard deduction, 12,550 from the table here. Say for the single, you have this standard deduction, but itemized deduction is the deduction that is given in these questions altogether, gives you itemized, which is 5,850. Since this is higher, use this to find taxable income. For taxable income equals to adjusted gross income minus deduction. Adjusted gross income here is 40,500. See here, 40,500 minus dollar minus 12,500, because we are using larger standard deduction here. If you subtract, you get 27,950. That's the taxable income. In other words, the person is entitled to pay the taxes for this much money. Okay, that means 27,950 is the taxable income. Okay, now to compute the taxes, we got to look at the table. Now, if you look at this taxable income, which falls on 12% tax rate, see here, see, because 12,950 falls here. Therefore, we call that person is in 12% tax bracket. 12% tax bracket. That person tax bracket is 12%. What do you mean by that? That means he pay or she pay 10% up to 9,950, and remaining he pay by 12%. Again, because this is 27,950 is in 12% tax bracket, the person entitled to 10% and 12% taxes. That means person need to pay some portion of his taxable income by 10%, some portion by 12%. Okay, therefore here 10% of 9,950. Notice that 10% up to that money, right? Then 50%, 12% of what? Remaining. How much remaining? 27,950 minus 9,950. Because 9,950 is paid by 10%, the remaining is supposed to go for 12% rate. Make sense? And let's subtract this one. This equals to how much? This is the math. And this is going to be, if we subtract this number, is going to be 18,000. Okay. Therefore, 10% of 9,950 is equals to 995. Okay. Or you can do this. You just do this. 0.10, 10% of 9950, which equals to 995. This is the 10%. Now 12% is 0.12 times 18,000, 18,000. The number gives you 2160. Okay, again this everything is dollar. Okay, $2160. Therefore, we get these two numbers, 995 with 10%, 2,160 by 12%. If you add, that's called tax computation. It's going to be 995 plus 2160. That gives you $3,155. Now, to find the federal income tax, eventually, we call just income tax, that's fine. Income tax equals to tax computation subtracted tax credit if there is some, but there is none. Therefore, you have same income tax as tax credit. As tax computation, because you subtract 0. Notice that this is the tax credit. Okay, this is the tax credit. You always subtract tax credit from tax computation, and the income tax is going to be $3,155. That's the answer for part A. Okay. Part B, married filing jointly. This is the taxpayer filing status, married filing jointly. Now, gross income is $155,000. Adjustment is $21,500. And first step is you find the adjusted gross income. Since we already have a gross income, adjusted gross income, I write in short form AGI, is going to be gross income minus adjustment. How much gross income? 155,000 minus adjustment is 21,500. Okay, 21,500. If you subtract, you get adjusted gross income 133,500. Okay. Now let's find the taxable income. To find the taxable income, you look for deduction. Let's find the standard deduction. Standard deduction. You look for the table. Since married filing jointly, that's the table you are looking for. This is the row you're looking for. Sorry, this is the column you're looking for. Married filing jointly, that's the status, right? Married filing jointly. Therefore, the deduction here is 25,100. Okay, 25,100. But what's the itemized deduction? Item deduction. Those deduction here, you see all of these numbers is item deduction. Where you add all these numbers: mortgage interest, charitable contribution, property taxes, state taxes. You add all this number. All this 1, 2, 3, 4, and you get itemized deduction is going to be 36,350. Okay, if you add this all this number, you get itemized deduction, which is 36,350. Makes sense? Now, since itemized is higher, use this. This is the higher, right? Use this to find the taxable income. Therefore, what's the taxable income? Let me do it here. Taxable income equals to adjusted gross income minus deduction. Here we're using itemized deduction since it's higher. Therefore, we do adjusted gross income 133,500 minus deduction is 36,350. Okay, we subtract, you get 97,150. This is taxable income. And if you look at the right column, and this portion, married filing jointly, this portion is in, let's say, is in 22% tax bracket. You see that? Here. Let me, here. Modified jointly is here. Over here, right? 22% tax bracket. See that? 20%. We call this person tax bracket is 22%. This person tax bracket is 22%. What do you mean with that? That means the person pays 10% up to 19,900, 12% between this amount, and 20% of the rest. Okay, let me write down here how you divide this 97,150. Let me write down here 97,150 is what? That's the taxable income, right? Taxable income. That's what you found here. 97,150. Now you pay, let's say 10% up to of 19,900. Okay. Let's see how much is that. 0.10 times 99900, who's going to be 1900 990. Okay, that's for 10%. Okay, upper limit for 12% is $81,050, and upper limit for 10% is $19,900. If you subtract this to upper limit, you get the amount that goes through by 12% interest tax rate. For 12% of 81,050 minus 19,900. Okay, and if you subtract these two numbers, you get $61,150. And what is 12% of $61,150? Let's do the math. This gives you $7,338. Therefore, with 12% tax rate, the person need to pay this much income tax. Okay. Okay. Now let's find how much income tax for 22% tax rate. Okay. Notice that taxable income is 97,150. That's the taxable income, and upper limit of 12% is $81,050. And if you subtract 97,150 and $80,050, that difference is going to be applies to 22% tax rate. Therefore, 22% of $97,150, which is this taxable income, minus $81,050. Okay, if you subtract, you get this number. When you subtract, this gives you $16,100. Therefore, I'm trying to find 22% of $16,100. That goes to $3,542. Oh, this is the $3,542 is taxed because of 22%. Okay, and now we have three different tax amount. Let me highlight that. The one is 10%, by 12% this much, by 20% this much. And if you add all this tax, this is called tax computation. Okay, then how much tax computation? You add all these taxes here. It's called tax computation. It's going to be 1990 plus 7338 plus 3542. Okay, and if we add all these three taxes, you get total $12,870. That's the tax computation. $12,800 tax computation. Since we have tax credit in this part B, how much tax credit? 7,500. Therefore, to calculate the income tax, you have to subtract this tax credit from tax computation. Okay, that's the way number. Let's see how much income tax going to be. Therefore, you're subtracting tax credit 7,500 from tax computation to find the income tax. Alright, therefore the income tax is going to be, let me see here, dollar, how much dollar? 53.70. That means $5,370 is income tax. Okay, that's the final answer for part B.